Namaste, Sat Sri Akal and Adab. Welcome back to One on One with Mr. Bond. Today's discussion is going to be a very interesting discussion. This is a raging debate on passive versus active investing. No better guest than Pratik Oswal, Chief of Passive Business in Motilal Oswal Mutual Fund, who are known for actively managing the equity space, but they have an equally large basket on the passive side also. So today we will have some eye-opening discussions with Pratik in terms of how should you view passives? Should you view it as a competition to the active? Should you view it as a complementing asset class to active? How do we create and construct portfolios for our investors based on passive versus active? But before we begin, and I invite Pratik on in my studio. Let me just explain to you what is passive versus active. Actively managed funds aim to outperform the benchmark index by leveraging the expertise of professional fund managers, where fund managers will be selecting the sector allocations, stock allocations, etc., while passive funds seek to replicate the performance of specific index. Welcome, Pratik.
Hi, Sunil. Thanks for having me out here, and I look forward to having a great conversation with you today.
No, an absolute pleasure. So Pratik, this is a very raging debate which is going on from time to time. Sometimes the actives do well, sometimes the passives do well. And naturally, at that point in time, those points in time, the mutual fund distribution community, the advisory community, etc., start to jump from one segment to the other segment and vice versa. So what I introduced in terms of the concept of passive versus active, if you can throw a little bit of light on what is passive and what is active.
Sure. I think when it comes to investing in the equity markets, I think there is typically two ways of investing into mutual funds. If you're looking at at least equity mutual funds, one is called active management, the other one is called passive management. In active, whatever you said was absolutely true. The idea is to really bet on a fund manager, do the stock selection, which stocks to buy, which stocks to sell. And the fund manager's job is to make sure that they are, I think doing well in terms of performance. Whereas in a passive fund, passive funds are basically low-cost index funds. They're essentially funds that are built to mimic a specific index. A lot of people have heard of NIFTY Sensex. So when you are investing in a index fund, a NIFTY index fund, essentially your returns are going to be the same as what the NIFTY delivers. So the NIFTY today goes up by 5%. The NIFTY index fund will also go up by 5%. What people have realized over the last 10 to 15 years time, that actually passive funds are extremely easy, low cost, and they also actually end up giving very good returns over the long run. What we've seen is that a lot of investors, especially in the US, have adopted passive funds in a very big way. There, I think more than half the mutual fund industry is passive. So essentially, the idea is it's a very simple fund. There is not a lot of stock selection. There is not a lot of fund selection that is involved in passive funds, which is a lot of investors tend to go ahead with passive funds. But very important when it comes to actively managed funds, it's very important that actively managed funds are able to outperform the benchmarks or outperform the index over longer periods. That's very important. Whereas in passive funds, the expectation is that you're able to sort of meet the returns of the index. It won't be perfect, but it will be almost there over sort of long time periods.
Sure.
And also just to add here, NIFTY and Sensex are actually very small examples of passive funds. Today in India, you have approximately 500 passive funds.
Wow.
Across different geographies, different asset classes. You have gold and silver commodities. You have international passive funds, Nasdaq, S&P 500. You have mid-cap passive funds, small-cap passive funds. You also have, strategy funds. So there's a lot of categories, of passive funds that have come up in India. And also there's a lot of investment is also that content from the market. Passive funds used to be about, 6 to 7,000 crores total in 2015. Today they're close to 8.5, 9 lakh crore, almost 70%.
Wow. Amazing. What a growth. What a growth of the passive fund side. So, let's begin with the most popular passive fund or the most popular index and the passive fund versus active fund for that particular index, which is Nifty 50. Now, what we are showing to the audience right now is that, it's an uneven weightage of sectors and stocks in Nifty 50. We will come to, your thoughts on what should be the alternative to this Nifty 50 in terms of passive funds and what is your favorite, etc. But in Nifty 50, there is an uneven weightage of stocks. So as you can see, HDFC has a allocation or weightage of 8.1%, Reliance has 12.86%. So the top 10 stocks constitute almost 55% of the Nifty 50, and balance has only 1 to 2% weightage. The balance stocks, which is 40 stocks, will only have 1 to 2% weightage. So is this not unevenly distributed index? And sometimes, these some of the stocks may do well, some of the stocks may not do well, and that's the way the performance of the index also will differ.
Yeah, so it's a great question. As you can see, Nifty is pretty top heavy. I think Nifty 50 is very top heavy. You're essentially, the way the index fund works is that the larger the company, the more weightage the index gives to it. Because Reliance and HDFC Bank are large companies, I think almost 10 to 15 lakh crore. They are given very large weightages in the Nifty. And that's how passive funds work. As companies get bigger, their weightage or their shareholding in the passive, their weightage in the index fund goes up dramatically over time. And this actually is a very good way of investing, because it ensures that the company is doing well, will continue to do well in a portfolio over the long run. But yes, as you said, the Nifty 50 index fund today is almost 55% of the Nifty 50 of your investments in Nifty 50 go in the top 10 stocks. That is also obviously, and that is obviously may not be the best strategy for a large part of your portfolio, because then you are exposed to top 10 stocks, and your wealth to top 10 stocks. And we believe, at least in Motilal Oswal, is that you should diversify your money outside of Nifty 50 for you to really take advantage of index funds in a very big way. So there is obviously a lot of stock concentration that is happening in Nifty 50. There's also a lot of sector concentration.
Absolutely.
The Nifty tends to be overweight on financial services and IT, maybe oil and gas.
Almost 35% plus.
Yes, 35% plus. So I think by diversifying your sort of investments over, say, instead of 50, say 500 stocks.
Sure, I'll come to that, but let me explain. Right now what we are trying to discuss for the benefit of the viewers is the most favorite index, which is Nifty 50, passive versus active investments. What are the pros and what are the cons? Now let me explain to the viewers that Reliance, which is all of a sudden become a darling of the investors currently, almost did not deliver from 2010 to 2017. It did not deliver any returns for the investors, in spite of the fact that it was a heavyweight in the index of Nifty 50. Something similar is happening in the HDFC Bank space also. From 2021 to 2024 now, for the last 3 years, the rates have been almost at the same levels. So there will be some stocks which will underperform, some stocks which will outperform. And when they are heavyweights on the index, there will be some kind of a, returns expectations will come up or go down. So what are your thoughts on this?
No, absolutely agree. I think what happens is, the scope for an HDFC Bank or Reliance to double is much harder than a much smaller company. Say a company which is half the size or maybe 1/4 the size. For Reliance to double its business, it's much harder. But obviously, the business is a lot more stable. So I do agree. I think because you're exposed to the top 2, 3, 4 companies, and because what we've seen is, at least in the Nifty, these companies have not really done a lot over large periods of time. HDFC Bank, for example, hasn't done much in the last 3 to 4 years' time. So we do believe that the large weights in these in Nifty may not be meaningful towards wealth creation in certain time periods. But that's one aspect. The second aspect, and this is something which maybe investors should know, is that Nifty 50 may not be the highest performing index, because obviously you're betting on the top 10 large companies in India, which find it difficult to really grow exponentially at a very fast rate. But because of their stable business models, their stable balance sheets, they tend to be very stable during bad markets. So what we've seen is that the reason why you should have exposure towards large caps.
Absolutely. So it reduces volatility by investing in a Nifty 50 kind of an index.
Absolutely, yeah. So large caps tend to do extremely well during bad market conditions. And what we've seen in a lot of investor portfolios is that they tend to be very small and mid cap oriented. But I think those, tend to do bad doing bad. So those are very volatile and tend to have much larger drawdowns. But we believe that having large caps in a portfolio really stabilizes your portfolio, and it's much easier to hold on to those companies for a very long time.
Yeah, right. So, generally the discontent in amongst the investors in terms of investing in the large cap versus actively managed large caps versus the indexes, that indexes, the actively managed large caps are not outperforming the index. Now, that can be because of certain reasons like Reliance not doing well for 10 years and then all of a sudden it started delivering returns, or currently HDFC Bank is dragging the index down, etc., etc. So, that narrative which keeps on changing, I'm discussing this for the benefit of the viewers, is based on the underlying stocks, their weightages, and how they are performing during certain pockets of time. Am I correct in saying that?
No, absolutely, absolutely. So I think it's very hard for you to time markets or time stocks.
Exactly. So active versus passive in a large cap space, when the all of a sudden the index starts doing well and the underlying index stocks start doing well, naturally the actively managed funds may not have those stocks or those sectors because of the investment policy guidelines, etc. So that may be one of the reasons. So is equity-weighted stock Nifty a better bet than a Nifty 50?
Not really, to be honest. I think it really depends on the market scenario. At certain regimes, equal weighted will do extremely well, but certain regimes, equal weighted does not. I think if you look at equal weight as a strategy, it does extremely well during expansionary phases when smaller companies tend to do a lot better than large companies. But across market cycles, if you are going through a bear market, then equal weighted may not be a right strategy because you're basically defocusing on the more stable names. But generically, I think coming to the point, what we've seen is that overall the efficiency of the markets are extremely high in the large cap segment compared to the small and mid cap. So finding value or finding stocks that are mispriced is extremely difficult.
Very difficult.
Large cap company is covered by 35, 40 plus analysts. There are about tens of thousands of investors all over the world who are looking to find value, and they tend to focus mostly on the large cap names because they tend to be the most stable and all of that. So I think efficiency, even in India, tends to be quite high in the large cap, which is why people are now looking at passives as a way to play large caps. Obviously, there is no right answer for what is good, what is bad. We keep telling investors is that having a passive allocation really makes sense from a portfolio level. I think it doesn't make sense for you to really bet on one or the other.
Absolutely. Now tell me, now let's talk about the sectors also, because we are not almost 37% currently is in financial services. IT is about 13.5%. Oil and gas is 11%. So some of the sectors are also again concentrated sectors allocation as far as the large cap is concerned. So how should one view this? Is it this is not really the entire economy? It's not representing the entire economy. It's not representing the China plus the manufacturing, etc., etc. So how do you view this index based on the sector allocation?
Yeah, that's a good question. So there's two answers to this question. The first answer is that you're absolutely right. The sector concentration tends to be extremely high in Nifty 50. There is not a lot of, so only I think 13 or 14 sectors out of 21 are represented. And so it's not really all encompassing. That's number one. Second is that Nifty 50, when it was made in the early 1990s, used to be a large cap index. Today, it's honestly half the large cap stocks in India. It captures about less than 40, about 40%, 40 to 45% of the entire Indian market cap. So it's a very small part of India. So I think equating buying the Nifty to buying India is not the right thing to do. Firstly,
absolutely
small part of India, and more than half the money is going to the top 10 stocks, which may not represent India. So we do believe that Nifty 50 may not be as relevant as it was 10 years ago when it comes to really investing in India as once. The second answer is that, honestly, it doesn't really matter as much over the long run. The why I say that is because if you look at the Nifty 50, when you're buying a Nifty 50, you're not really buying oil and gas or financial services or IT. You're buying the top 50 companies in India, essentially.
Right.
The top 50 companies in 2005 used to be infrastructure, power. Maybe 10 years later, it was, IT. Today, it's financial services. Tomorrow, it might be something else. So, with the top 50, we may not know what the top 3 or 4 sectors will be in 10 or 15 years' time. But we know for sure that the top 50 companies in India will be bigger than what they are today. And that's why the Nifty really makes sense.
Absolutely. So if you compare this with the US index also, S&P 500, when there are top 7 or 10 stocks which have really done well. So is it something similar or akin to what we are seeing in the Nifty 50 also? Is that what your story is, or is that what the narrative is?
Yeah, so the narrative is slightly different. In the Nifty 50, in fact, Nifty 50 has actually not done well in terms of performance in the last maybe 3 to 5 years time, and that's because, as you said, the top heavyweights have not really moved much, which is why incrementally, if you look at the flows in mutual fund industry, a lot of flows have come into small and mid cap because that's where the performance is. And compared to the US, actually, it's been completely the opposite. Where the top 10 stocks have delivered. So if you look at the S&P 500, which is the top 500 companies in India, in the US, 80% of the incremental gains in the stock prices have come just from the top 8
From
companies.
the top 10.
Top 10 companies. So it's been exactly the opposite in the US in the last 1 year, which is crazy. So I think very, very different things have happened. Again, I think if you were an index investor in the US, you would have really done amazingly well. Whereas if you're an index investor in India in the last 1 year, you obviously would not have done as well. I think the small cap index is up around 70-80%, whereas
It's
Nifty is up
crazy.
20%,
Absolutely.
30%. The
So,
outperform smaller and mid caps have been quite large. So we believe
yeah,
that
sure.
market exposure makes a lot more sense than just taking the top 50 names.
So the reasons which I can, enlist for the viewers is that why large cap actively managed funds generally cannot generate alpha over the benchmarks is the less stocks in the basket, because it's top 100 in terms of market cap constitutes the large cap. Efficient markets, well-researched space. So as you rightly said, there are 35 to 40 analysts plus the global investors and the analysts. Investment guidelines may not permit to invest in certain sectors, stocks like oil and gas, etc. And you may miss the bus, or if there is a commodity play, then you may miss the bus because of that reason. Also, higher expense ratios also of actively managed large cap funds versus the index funds. Am I summarizing it correctly in terms of why large cap space has not been able to deliver big alpha on an ongoing basis consistently versus the index funds?
Yeah, I think that's true. Yeah, I think that has been the case over the last 5 years. That finding alpha in the large cap space is difficult. Has been difficult, and I think it continues to be difficult then.
So tell me now, what is tracking error for the benefit of the viewers, and why do tracking errors occur?
Yeah, so when it comes to passive funds, the objective of a passive fund is to replicate the returns of the benchmark. But in reality, that doesn't happen exactly. There is a small difference between what a index fund does versus the benchmark does, which is the index it's trying to replicate. And this is because you have fees, you have transaction cost, you have something called expense ratio. So all of this combined leads to some tracking error or a difference between the index versus your fund returns. So for example, if the Nifty, you're buying a Nifty index fund and the Nifty index does about 15%. The Nifty index fund will probably do about 14.7, 14.8%. The balance is called the tracking difference. And that happens in all passive funds across the world because you have to account for expenses, costs, and all that. So I think very important. Even index funds don't beat the benchmark, but also they have a small sort of underperformance because I think for investors it's very important to understand tracking and tracking difference, because when you're looking at selecting an index fund, unlike 5 years ago when there were not a lot of options, today there's lots of options.
Lots of options. So
So
lower the tracking error, the better it is in terms of the performance of the scheme. Is it possible because you may be holding some cash also in the portfolio for redemption pressures, etc., and that also creates a tracking error?
No, not really. So index funds are not, most index funds today don't hold any cash.
Okay.
Invested in equity. So for redemptions, you sell equity.
Sure.
But it happens because there is some small cash allocation, and that's because of, I mean, it's a bit technical, but it happens because, in some cases, some of our partners tend to, report investments after market hours. So because the money is lying in a sort of common pool account, the point being is that, yeah, there's some small cash, but it's very minuscule. It's very insignificant level of cash that that's been pulled. But most of the tracking happens because of transaction cost and expense ratio.
Sure. Perfect. So now let's get on to, so far we've only spoken about one particular index and the index fund, and on that, why passive versus active and various aspects of that. Now let's talk about passive funds and the why investors should be looking at passive funds. So we will create a case for passive funds going forward now. The passive fund investing involves buying portfolio of investments that track a broad market index such as Nifty 50, 500, etc. The goal is to match the performance of the chosen index. Passive investments are typically low-cost index funds and or ETFs, and passive investing is a buy and hold strategy. It is based on the efficient market hypothesis, which states that it is difficult consistently to outperform the market through active management. So this is the thesis and the a case for decoding passive funds. What more can you add to all these points which I've just spoken, or if you can elaborate on some of the points?
Yeah, so I think passive funds can be used for different purposes. I think a lot of people use passive funds to time the market. They want to go long on small caps, they can go through a small cap index fund or ETF. If they want to make a long term sort of, I think when it comes to me, the three main things which we think about passive funds is it's very easy, effective, and economical. There are three E's that I keep talking about.
Right. We'll come to that. Yeah, the benefits of passive funds.
Yeah, the benefits of passive funds. But I think I would disagree with the fact that most funds, yes, a good amount of funds will have difficulty beating the benchmark. But that is the whole idea behind active managed fund. In an actively managed strategy, you are essentially following a strategy, and every single actively managed strategy will outperform or underperform at certain periods of time. That is something which people have to live with. So I think it's very important that people don't do this very like-to-like comparison between active and passive, because I think there are different strengths and weaknesses. If you look at the US as a country, their passive funds have been around for almost 5 decades, 50 years. And if you look at an average investor portfolio, they'll probably have roughly half active, half passive. So what we tell investors is to have an allocation as opposed to selection of passive funds. Having going 100% passive is not something which most people do nowhere in the world. So I think but what we see in India is people have a 0% allocation to passives.
Right.
That's need to change. Maybe have a 20, 30, 40% allocation to passive.
So now let's build the case for passive funds. So basically what we are saying is there is a threefold advantage. You just mentioned that. One is the easy, economic, and effective. So if you can just elaborate on each one of them.
Yes. Yeah. So basically, these are the three advantages of passive funds. And this is why, I think, so easy is basically, it's a fund which will, where there's not a lot of selection required. When it comes to you buying a mid-cap fund today or a small-cap fund today, you really have the option to choose between, say,
there are 30, 40, 50 funds in each category. So how do you select a fund? So it's better that it's easy to select an index rather than in selecting a fund.
It's just easy to do with the small-cap 50 index, and you're done. The performance is going to be good. It's low cost, and it will do well over long term. The second reason is low cost. I think that's a big reason to why people like passives, because they tend to be a lot cheaper than actively managed funds. People.
No, can you elaborate on low cost? Because there will be some cost of managing the fund also, right? So how do you reduce the cost there? What are the differentiation between active versus passive on the costing?
Yeah, so I think on average, a passively managed fund in India will be less than approximately 1/3 the cost of an actively managed fund. And what that does is that more of your money is invested in the underlying stocks. Obviously, you're not getting access to an expertise of fund manager. So that is something you have to give up. But in return, you're essentially having more of your money invested in the underlying index. So a lot of investors want to invest in simple, low-cost strategies. And that's where passive comes in. And the third reason to why passive funds do very well is because they're actually done very well in terms of performance. I think what we've seen is that over the last 10 to 15 years time, if you compare an actively managed fund or a passively managed fund or any fund altogether, I think what we've seen is that the returns that passive funds have delivered is very good, very competitive. So I think it's a very easy way for anyone to start wealth creation, especially for someone who's very young, who's looking at investing for say 30, 40 years. Honestly, you can just invest in Nifty 500 and forget it. It'll never underperform the index. It's low cost. So I think for someone who's looking, and it's very hard for you to select a fund looking at 40 years ahead.
1500 to 600, 1600 schemes in the mutual fund space. So
Yeah,
it's
exactly.
very confusing for any investor.
Yes, yeah. So I think very confusing. So we say that, obviously try to, do well, but at least have an allocation, a long-term allocation towards passives, which I think is maybe you can have a 33 to 5 allocation when you're looking at actively managed funds, but then for a passive, maybe your allocation can be for 10, 15, 20 years.
Sure.
I think that's how most of our customers.
The other narrative in terms of active versus passive is of course the performances of actively managed funds versus the passively managed funds. But the unfortunate part, what the investors and the viewers don't realize is that the best performing fund versus the worst performing fund in the same category, there's a huge difference. So if the data which I'm going to share with you right now, as you can see, in the best performing fund in the large cap has delivered 22.8%, and the worst performing has performed 10.59%. Average of all has performed 15.47%. The benchmark index, which is the Nifty 50, has delivered almost 14%. Something similar in FlexiCap, the best is 31%, the worst is 7.55%, average is almost 17%, and even the index fund, which is the Nifty 500, has also delivered 17%. And then the story on the mid cap and the small cap is also similar. So what are your thoughts on this? There's a huge chaos as far as the investor's mind is concerned in terms of what to select, how to select. If they select and then it becomes the worst performing fund, where do they go? So is that one of the reasons why you recommend that passive also should be considered along with the actively managed funds?
I think passive makes life easier. You don't have to worry about performance. I think you can sleep soundly. You'll get very good returns. I think, obviously, if you, the idea is always to have a combination of active and passive in your portfolio. I think if you are able to sort of really find the right fund, which you think will outperform or which will do very well over the next 3, 5, 10 years, then obviously active management makes sense. But if you are a customer investor who does not have advice, who's self-investing, or who just wants to keep things simple, then a passive funds make sense. So we believe that obviously, and a lot of people tend to over rely on past performance, which is something that we as industry professionals do not really recommend. We would recommend investors to look at performance, obviously, but also look at other factors like process, like what is the fund manager strategy, what is the track record of the asset manager, what is the expertise that they are giving you. I think that is a lot more important than just performance. So
Absolutely.
you're looking at actively managed strategy, maybe you can do a little bit more research and just at the returns.
And I think that's possible in the mid cap and the small cap story more than in the large cap story.
Yes, absolutely. So, that's what the industry, obviously, I would say norm is now that mid and small cap is where value is, large caps is where there is a lot of efficiencies. But honestly, the reality is that it keeps changing. Even in small and mid cap, if you look at the last 4 to 5 years time, the passive funds have done very well. Probably top 5 funds in the industry across mid and small cap are passive funds. So it really changes. In fact, the large caps, passive fund large caps last 1 year have actually underperformed most. So most of the best large cap funds of last year have been actively managed funds.
Absolutely. That's what the data also showed.
Yeah. So I would recommend investors to just look at it from a point of simplicity, as opposed to looking at performance of what does better or what time. I think if you are looking at it, look at it as an allocation. Say that what, out of my equity portfolio, I'm going to put 25-30% of my money in passives, and within passives, I am open to taking risks. So I can maybe do a large and mid cap, or if I'm not, I can do a large cap. Or if I really want to play the long term game, I'm very positive about small caps or micro caps, and I can invest in that. I think that is a much better strategy, I would say, over the long run, than just looking at, what does better in different market conditions. But I do agree. I think you should honestly, if you're looking at actively managed funds, then we would recommend doing a lot more research.
Sure. Now let's look at the benefits of investing in passive funds. One is simplicity. If you can just elaborate on each one of them.
Yes, so there's about 4 or 5 benefits when it comes to passive funds. Simplicity, as I said, is the easy. Very easy to select passive funds. You don't have to worry about performance or cost or what to select. Again, even within passive funds, there are a lot of choices, but there's not a lot of choices. There's about maybe 3 or 4 different types of large cap funds. So very simple funds, easy to understand, and easy to sort of invest in for very long time periods. Second is low cost. As I said before, very cheap, so more of your money is invested inside or in the underlying stocks. So you really save on a lot of fees when it comes to passive funds. Passive funds are also very diversified. Most passive funds are spread over 50, 100, 500 stocks. So you don't really have to worry about having stock specific risk in your portfolio. So I think that's one of the biggest reasons to why people invest.
But when you invest in a diversified Nifty 500, is it not too much of diversification also at the same time?
Not really, to be honest, because Nifty 500 seems like a lot, but the problem is it's distributed very well. Your 75% of your money is invested in the top 100 stocks, and the bottom 250 is like maybe 7% of your portfolio.
Okay.
Stocks. So I think there are indexes out there that so there is a popular saying that I think diversification is good. Too much of diversification is not bad. It's fine. It's not a bad thing.
Because here you're buying the market, you will get the market.
You're buying the market, so you're buying
the market, you'll get the market return. So you should not expect anything beyond that.
Exactly. And when you're buying the market, you're really taking advantage of everything. If small caps do well tomorrow, you do well. If large cap do well tomorrow, you do well. If this sector does well tomorrow, you do well because you have the entire market with you. So I think it's a very good way of playing Indian equities when it comes to this sort of. There is no stock selection risk also because they're well diversified.
Yeah, because that stock selection bias can be because of the fund manager's bias also sometimes.
Absolutely. So we didn't talk about behavioral aspect about passive funds. I think the beauty about passive funds is that there's no behavioral bias coming in place where you're not really. I think there's not a lot of. You're basically buying the market. You're not exposed to some good or bad decisions that someone may or may not take. So I think that's one big benefit of index funds. It's completely bias-free investing, and that's also one of the reasons to why people like it. And also, lastly, is also very efficient. I think and the reason why I say efficient is important is because if you look at the last 15 years, passive funds were extremely poor performing. Say in the early 2000s when they were initially launched, because there was a lot of like even Warren Buffett when he started in the 1960s, he was able to beat the benchmark very easily, by 5, 10, 15, 20%, because it was very easy to do stock selection because not everybody was involved. Now with the entire world going digital, with hundreds of stock analysts, people coming in and buying and selling stock on a minute by minute basis, you have quant funds that are buying and selling on a multi-second perspective. It's very hard for you to really seek value as they did. So the performance difference between active and passive funds has come down dramatically over the
dramatically. I totally agree.
Yeah. That's also
now there are some of the investment traps which the passive fund investing actually avoids. So what are these? So chasing returns is the first investment trap which the investors fall into. So if you can just elaborate on chasing returns as an investment trap and how does passive funds avoid that?
Yeah, so I think if you look at the entire mutual fund industry, one thing that what most people do is a lot of the money tends to flow into the funds that are doing very well.
Yeah, point to point returns, the past performance, rear view mirror.
Yeah, absolutely. So there is this, and it's not in India, this is globally.
It's everywhere. It's an investor's psyche, unfortunately. Right. It's a bias.
And also it's also the distribution model, right? So it's much easier for you to
sell.
Hard for a distributor or an advisor to sell a badly performing fund because they're taking career risk. That if it's already bad, and if I suggest it, and if it's even worse, I fall into trouble. Whereas in a high performing fund, if it does badly, it's just some fault of the market or whatever. So I do believe that this chasing high performing fund may not be the right reason. And we've talked about this before, where investors should look at doing research, should look at more than just performance when they're looking at selecting a fund, especially an actively managed fund. Also, passively managed fund. I think people now your passive funds across so many domains. Your small cap, mid cap, large cap, multi cap. People are now chasing. For example, we launched this fund called Micro Cap Index Fund, which is an excellent fund. No doubt about it. Good for long term investing. But there is a good amount of people who are buying this fund because of the high returns it has had in the past. So I think
Since
that
you launched the micro caps have really zoomed.
yeah, I guess we got lucky also, but we didn't expect that. But the idea is that investors should really not chase returns. For example, cryptocurrency. Most people chase returns in 20, I think 18, 19 when crypto was doing well. Even though the asset class has done well, most people have lost money. So there's a lot of these bubbles that keep happening. And I think the worst thing a customer or investor should do is invest in it just because everybody's investing.
Right.
So that's to
So
really
other advantage is the passive funds, you avoid chasing fads like the IT boom, the dot-com bubble, the pharma boom during COVID, etc., etc. So how do you avoid chasing fads? Because there are pharma index also, there is an IT index also. So if somebody is just investing into those indices, is he avoiding to chase the fads? How does this work in passive funds?
These passive funds, the broad-based funds, they're very well diversified across sectors, stocks, schemes. So I think by investing in a broad-based passive fund, you are essentially avoiding fads. You're investing in the market, and the market will change when the market changes. For example, in a passive funds, when there is a poor performance of IT, and if IT prices go down, it automatically, the significance of IT in a portfolio automatically goes down because that's what the index is structured.
Correct.
So right now is 20%, and if it was badly, it goes to 10%, and then it doesn't really matter in a portfolio as much. So I think the
Absolutely.
index rebalances itself towards good and bad sectors, and it does it over decades. So it really sort of rebalances in such a way that you're always having the top 500 companies at all times. You're always ensured that the best companies in the world, you are owning them. Like, for example, NVIDIA. It's a company which has really shot to like fame in the last 10 years. And guess who were the biggest investor of NVIDIA? Passive funds.
Passive funds. Absolutely.
Nasdaq, S&P. They have been the biggest, investors. So I think it really helps because you are essentially buying the entire market. You are buying everything that does well, and whatever does badly gets smaller and smaller and smaller. So it becomes more and
So
more
you're diversifying the risk over many stocks and sectors.
of sectors, and whatever does well in a portfolio. Whatever does badly gets smaller and smaller, so it gets more and more insignificant in your portfolio.
So another investment trap which the investors can avoid is the risk profile drift. So they may chase small caps, they may chase a micro cap, which may or may not have fitted into their risk profile, but because they are chasing returns, that's the reason why they are chasing all these kind of fads or the riskier asset classes. How do they avoid in the passive funds?
Yeah, so I think the risk profile drift is a very serious thing. It leads to a lot of wealth destruction because a lot of people tend to be over aggressive in good times and over conservative in bad times. And I think that leads to poor investment performance actually. So most people think that if I just invest, I'll make money, but actually, if you over invest in good times and under invest in bad times, you'll actually do badly. So I think, and that could happen with a lot of funds. I think it could happen with passive funds, active funds. So it's very important for investors to not really look at what's trending, but invest as per their risk appetite. If you only invest in small caps, if you have the risk appetite to invest in small caps, only invest in micro caps if you have the risk appetite. If you don't stick to large caps, even though small caps will do well, you might feel bad, but then over the long term, what we've also seen is that investors who stick to their risk profile end up making the most amount of money in terms of wealth creation. It also helps you really stick towards long-term investing
So what I'm hearing you say, Pratik, is basically even in the index funds also, the passive segment also, there is a index fund which can be representing IT, it can be representing pharma, reality, etc., etc. But if you avoid those sectoral allocations and stick to that Nifty 500, Nifty 50, mid cap 150, etc., etc., you will be avoiding over allocation also. You will be avoiding drifting away from your risk profiles also, and at the same time generate wealth for yourself.
Absolutely, absolutely. I think it's absolutely true. So avoid what you can't invest in, I mean, so basically, never evaluate a fund from its returns. Always evaluate from its returns as well as risk. When it comes to active fund, obviously you have to evaluate the strategy. When it comes to passive fund, always evaluate the risk profile of the fund. So if the fund is like a sectoral fund or a thematic fund, which most of them are very risky, avoid it because it doesn't really help.
It is so it is true for both passive and actively managed funds. When you get into sectoral, thematic funds, etc., naturally your risk profiles also you should be. Now, passive funds are true to label, absolutely true to label. When you say mid cap, it will be only investing in mid cap, and there will be no allocation of small or a large cap into that. The unfortunate part about the actively managed funds, or I don't know whether I should call it unfortunate or fortunate, in the large cap space, the fund manager has a leeway to invest at least 20% into large and in mid and a small cap. In a large and a mid cap space, they have to invest minimum 35% in large cap, minimum 35% in mid cap, and 30% is at the discretion of the fund manager, and so on and so forth. But in passive funds, when you are investing in large cap, it will be purely large cap, top 100 only. If you are investing in mid cap, it will be purely mid cap, 100 and first to 100 250th stock, and so on and so forth. So that is the major advantage, and that's where your asset allocation strategy, which you may be following, will be true to its label also. Is that correct?
No, absolutely. So I think again, yeah. So index funds need to be true to a label because they have to be 100% replicating the underlying benchmark. If the benchmark is Nifty 100, you have to replicate Nifty 100. Whereas there is some leeway given to actively managed funds, which honestly may or may not be a good thing. I think it's a fair thing because it's small leeway, so it helps fund managers to do risk management in a slightly better way. But we do believe that given this difference, passive funds are completely true to the core. So if someone is buying a small cap fund today, they can index fund. They know that 100% of the money is invested in small caps. Whereas if they might buy a small cap actively managed fund today, you might see an HDFC Bank there, you might see a micro cap stock there. So you might see a lot of mix and matches, which obviously is not bad. It's just it's actually good because the fund manager is able to be more flexible. But yes, I think as a category, it's all the funds are extremely true to the label.
Absolutely. So now to summarize for the viewers, active fund features is potential for outperformance, tactical allocation, professional fund manager, and active risk management. And the passive fund features are broad market exposure, low cost, efficiency, simplicity. So active plus passive, they don't compete with each other, but they complement each other. That's the message which I can hear what you are saying. Though you are managing passive, naturally you're the other side of the AMC is managing the active also. So they should be complementing each other and not competing with each other. And they should be all investors should have a mix of both passive as well as active, based on the risk profile, their perceptions, etc. So your last thoughts on this?
Yeah, absolutely. I think if people should look at it passive as an allocation, as I said. Look at it from if you're looking at investing in equity, I think, and if you're looking at something stable, something long term, I think, for example, if you're looking at investing for the next 15, 20 years, it's much easier to just select a passive fund and it's, have it run. I think that's very important. One thing we didn't mention in this conversation is that passive funds have no risk management. Have no risk management. So you're essentially buying the index.
Correct.
An actively managed fund, the fund manager might take a cash call. They might have over reliance on quality stocks, which have a lot better risk profile. They do better in bad market conditions. So I think obviously there are pros and cons. We believe that having a combination makes sense. That's how investors globally do it, and that's how probably investors will do it in India over the next decade. And I think very important. I think the as India obviously growing, as we have millions of new customers, new people come into the equity markets. Simple products is what a lot of people will sort of choose. Especially ones who are new to investing, and that's where passive funds really come in a very big way.
So, you have, I think, one of the biggest basket of passive funds. Am I correct in saying that?
Yes, that's right. So we have about 35 funds. So we have a lot of passive funds, across different categories, geographies.
So you are into debt also, you are into domestic equity also, you're into international equity also, you're into reality also, all through passive funds, ETFs, etc.
Absolutely. So we have the widest range of index funds in the country, across sectors, your broad-based funds, small cap, mid cap, large cap, commodities,
You have momentum, low volatility. So your basket is pretty well diversified in terms of what the investors can choose from. Now, your advice to the investors in terms of what should be the combination of passive versus active, and within the passive, which is your favorite index which they should be looking at, and why?
Yeah, so, for an investor who, obviously, so the reason why we have broad baskets because this is not all meant to go to one person. We have different type of investors. We have investors, all have different needs. So even though the basket is very overwhelming, we've designed the basket in such a way that it targets a certain segment. So for the retail customer or for someone looking at index funds who has not looked at it, we really recommend a broad-based index fund like a Nifty 500. If you're looking at more large cap exposure, if you're looking at mid and small cap, then look at mid cap 150 or small cap. So very simple broad-based funds are the best for your portfolio, will do very well over the long run. So those are
naturally international equity has to be through the passive funds. Am I right?
Yes. So even international equities, we obviously are market leaders in international equities, and we believe that when it comes to the US or other parts of the world, selecting out. So in India, you have 1,200 options. Globally, you have 12,000 options, or probably more than that.
Wow.
So I think index funds, ETFs make life very easy when it comes to selecting a passive fund outside of India. So I think definitely when looking at international allocation, I don't think most people look at anything outside passive funds. In domestics, we really, I think broad-based funds tend to be, I would say, the what we recommend. For some investors who are slightly more, maybe who are tracking the markets closely or slightly more track record, we are also recommending factor-based strategies, which is something which is very new in India, but it's a huge category in the US, approximately $4 to $5 trillion. And within factors, we have certain strategies which we're very positive and optimistic about. For anyone looking at, I think factors or strategy-based indices. So for someone who has had some expertise or track record.
So tell me, if I were to say that 25% in international equity through passive, 25% in large cap or a Nifty 500 through passives, and mid cap, active mid cap and an active small cap, that's a good basket and a good scheme complement of passive versus active as a portfolio.
It is perfect. That's how I would do it. That's an excellent way of diversifying.
Great. Thank you so much, Pratik. I think a lot of people would be getting a lot of clarity on after our this interview is aired in terms of passive versus active. So it's, all I'm trying to tell the viewers is that there's no one-stop solution or a one strategy which will work for everybody. Sometimes the passives will do well, but sometimes the actives will do well. Use them as a complementary scheme rather than a competing scheme and saying that, this will do better than the other ones. So don't get swayed by these debates which are happening on an ongoing basis, but do a prudent allocation to both passives as well as active. Thank you so much, Pratik.
Thank you, Sunil. Thanks for having me, and I look forward to coming back here soon.
Sure. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.